All right, so I'm sitting here with Joe Calloway with Asset Preservation Incorporated. He's the division manager of their 1031 exchange corporation. They are a qualified intermediary. Now, if you're a realtor who invests in Arizona, or if you're an investor in Arizona, then you'll definitely want to take time to call up Joe. His toll-free number is 877-279-1031. Obviously, it's 877-279-1031. Joe spent about an hour talking to us about 1031 exchanges and the importance. Joe, I just want to say thank you again for spending your time driving all the way down from Phoenix to spend time with us. Thank you.
Well, my pleasure.
So, Joe, what would you say in this podcast? Obviously, going into a 1031 exchange is a very deep subject. It's in the weeds. It's something that a realtor, an investor, they really got to know what they're looking for in a 1031 exchange. And so your type of information is very specialized. I'm wondering, what kind of things would you think, I don't know, maybe the 2 or 3, 4 things you think they really need to know if they're an investor or a realtor? What are the things that they're going to hear in this presentation you just put out that they need to know?
Well, the first thing I always talk about is the most critical, and that's getting the exchange set up prior to closing. Mm-hmm. Can't get it done until you have an accepted contract and you're in escrow. But once you're in escrow, call us and we get the exchange set up immediately for you. That's critical, because if you don't, there's no exchange, period.
Okay.
The other things that most investors look for in a 1031 exchange are timing. Okay, so from close of escrow, you have 45 days to identify, a maximum of 180 to acquire. So finding replacement property prior to closing is really, really helpful, because you can only buy what you've identified and you only have 45 days to identify.
Okay.
The other big issue is the requirement in the exchange. So you basically need to take your sales price, deduct your cost of sale, and at a minimum, that's what you have to buy for. You have to reinvest your net equity and reestablish the same or greater amount of debt.
Okay. So essentially what I'm hearing you say, the first thing that they really got to do is establish the exchange with a qualified intermediary, somebody they can trust like you, so they can go ahead and make sure they don't get left in the cold and have to pay a bunch of unnecessary tax. The second thing I understand you said that they need to do is identify the properties that they need to identify as quickly, as soon in the process as possible, so they can buy what they need to buy and not be without something to buy. And then finally, of course, establishing that basis is critical, so they can go ahead and not find themselves in a position where they owe taxes even though they've purchased another property. They want to purchase what they've paid. Is that what I'm hearing?
That's correct.
Okay, great. Well, Joe, listen, I really appreciate you taking a couple minutes to spend with us. And as always, thank you for driving down from Phoenix. I hope these people will take the time to listen to the message you shared with us, and I hope they take the time to give you a call with any questions in any business. Thanks again.
Thank you.
All right, Joe. Have a great day.
Appreciate it, you too. Thank you, Lauren. Hey, let's give Stuart Tattle, our sponsors, a big hand putting this together. By the way, if anybody needs a tour of Sabino Canyon, I can give it to you, because I was there this morning. I went too far, way too far. Well, good morning, everybody. Almost afternoon. My name is Joe Calloway. I'm the Arizona Division Manager for Asset Preservation. Asset Preservation, leading national qualified intermediary. Qualified intermediary is a company that facilitates 1031 exchanges based on the rules, regulations, safe harbors of the IRS. How many of you have done an exchange? Good, about a third. 1031 exchanges exploded really in 2013. Who can tell us why? There's 2 big reasons. One, for the first time in 8 or 9 years, people are starting to realize a gain again, right, in terms of selling real estate. But 2, and the really big one, is that capital gain tax went up January 1st, 2013. Went up a lot. How many of you think it went up at least by 20%? 30%? This is interactive, guys. 40%. Capital gain tax went up by 58% January 1st, 2013. Okay. And the new tax law of 2017 did a lot of good things, but it did nothing to abate the capital gain tax, right? So that's one of the biggest reasons why 1031 exchanges have absolutely exploded. So what I'd like to do before we get into the class outline is just kind of go through a deal, okay? How it works, what it does, and on top of everything else, I'm hard of hearing, so please speak up, okay? What's your name, ma'am? Yeah. Okay, what's your name, ma'am?
Dawn.
Dawn. Okay, so Dawn owns a property in California. She's gonna sell that property. She puts it on the market. She accepts an offer. Sales price is $275. We're talking about California real estate. So selling for $275, that must mean it's in Bakersfield or somewhere like that, right? So she's selling property for $275. And 2 days before she closes, she goes to her CPA and finds out what her tax hit's gonna be. Now, she's owned this property for a long time, property's fully depreciated. So, selling for $275, her CPA tells her that she will owe, this is not the gain, this is what she owes in tax due, $75,000 in tax due. So the next day she's signing closing documents and she tells her escrow officer, she says, look, if I could get out of this, I would, because I would just take the money and buy property here in Tucson, but it's too late, so I don't know what I'm gonna do. And so the escrow officer says, well, if you're gonna buy other property, have you considered a 1031 exchange? She says, what's that? They pick up the phone and Dawn calls us, right? While she's signing closing docs. So we talk about 1031 exchange, we answer all her questions. The question is, and one of the most critical things you can get out of today is what we're gonna learn right now. The question is, can Dawn still do the exchange?
Yeah. There's a time.
We like more than 20 minutes when we can get it, okay? But she can absolutely still do the exchange, all right? So we answer her questions, we create the exchange docs. The critical thing in a 1031 exchange, ladies and gentlemen, I get at least 4 to 5 calls a week, and the call goes like this: Joe, I'd like to do an exchange. My first question, great, when did you close it? Closed last week. It's too late. The critical thing in a 1031 exchange is that you've got to get the exchange set up prior to closing. Now, I've had the highest end realtors, I've had the highest end commercial folks in the state call me and say, Joe, there must be something we can do. There's nothing you can do. Once you close, that's a taxable event, and you're gonna have either constructive or actual receipt, and as a result, it's a taxable event. Too late to do the exchange, okay? So we get the exchange set up for Dawn. Dawn sells the property, she closes. So what happens in a 1031 exchange is that the proceeds, the net equity, comes to the QI, right? And we hold it until Dawn is ready to buy replacement property, what's called replacement property. So in 1031 exchange, you gotta sell property followed by the purchase of replacement property. So Lauren has a property for sale here in Tucson, and that's what Dawn's looking to buy, okay? Dawn finds Lauren's property via the MLS. Dawn creates an offer, offer's accepted. Financing's required in this transaction, right? So Dawn sets the financing up, then she calls us, we wire transfer money to title, Dawn acquires Lauren's property. End of 1031 exchange, okay? Now there's timing involved, right? So from close of escrow, you have 45 days to identify, 180 to actually acquire. The rub with that is that you can only purchase what you've identified, okay? You can only purchase what you've identified. So getting due diligence done and property under control as early on as possible is key. Try to get it done prior to the 45th day so that you know that you can buy what you've identified, right?
Can I ask you something? How do you, when you say identify, what does that?
Okay, identification, we're gonna go through that a little bit. Identification is a process of the exchange, okay? One of the most key, one of the more important things you can do is to have property under contract before you even close on what you're selling. So have the replacement property under contract before you even close. Anytime I talk to a client, I beg them, Get that real estate professional looking for replacement property as early in the process as possible, okay? So Don acquires Lawrence property, okay, end of 1031 exchange. Now, that property cash flows really well, and so Don just holds on to it. She could sell that property an endless amount of times, the property she bought from Lauren, right? An endless amount of times to do other exchanges, never recognize the gain, never pay the tax, okay? But that's not what happens. Property cash flow is great, so she holds on to it, okay? Suddenly, Dawn's heirs inherit that property. The question is, and this is key, this is one of the reasons why this section of tax code is the most powerful tool left to us in investment real estate today. When Dawn's heirs inherit that property, all of the deferred tax is wiped out. Because heirs get a stepped up basis, today's value, and via the step up, the deferred tax is completely wiped out. Okay? Most powerful tool left to us in investment real estate today. Now, why would Dawn do this? Everybody understands the time value of money, $75,000, 75,000 reasons why Dawn should do this 1031 exchange. Again, most powerful tool left to us in investment real estate today. Yes, sir.
Could you give us a brief example of something in real life that you might have seen where this might have happened, to put some actual numbers on this, to give us some perspective? Do you have an example like that?
Well, let's use the numbers here, okay? So Dawn's sales price $275. Let's say she had a kind of high cost of sale for this deal, $25,000. Her net is $250. She's got $125 in equity and $125 in existing mortgage that was paid off via the sale, right? So the net equity comes to us, okay? We hold that until Dawn is ready to buy Lauren's property. When she's ready to buy Lauren's property, she gets her finance set up, and then we can wire transfer the $125 to title. Dawn acquires Lauren's property, okay? In terms of examples of
The remainder in the step up.
well, in this deal here, she had $75,000 in tax due, okay? When Dawn's heirs inherit, that $75,000 is wiped out.
Right.
So I mean, just a key element in terms of doing exchanges. I was talking to an existing client yesterday who's done like 4 or 5 exchanges, and we were just talking about a kind of new thing that came up called an opportunity zone, and I said, "Do you have heirs?" And she said, "Yeah," because she was thinking about selling outright versus exchanging one of her properties that she'd already exchanged into, so she's really low tax basis. So I said, "Do you have heirs?" And she said, "Yeah." And I said, "Will you realize that when your heirs inherit these properties, they inherit them on a tax-free basis. All of your deferred tax is completely wiped out." And she was amazed. She was absolutely amazed.
And why is that? I mean, where does it, how do we just get out of paying taxes? I mean,
Well,
someone's got to do that.
unfortunately, Dawn, in order for heirs to inherit, you gotta die. So,
That's the downside.
but the point is, that $75,000, as an example, that $75,000, you can either pay it to Uncle Sam, right? Or, you use it, you leave it in the exchange for your entire life, and then when your heirs inherit, they get what's called a step-up basis, okay? So your basis is what you paid for the property, okay? And when you do a 1031 exchange, what happens is your basis carries forward. So your basis is what you paid for the property, and you're taxed on the difference in what you pay for something versus what you get, right?
Yeah.
When your heirs inherit, they get a step-up in basis to today's value. In other words, your basis is wiped out, their basis is today's value, and as a result, it wipes out all the deferred tax. And they get to inherit that tax-free in terms of capital gain tax. That answer your question?
Yeah, I mean, I'm sure I'll get it more as we keep going.
Okay.
Can I try and summarize and see if I understand? Here's the deal. The federal government, you owe them $75,000, the government says, you know what? Don't pay us now, keep the money, as long as you use it to invest and make more money. So it's a free loan from the government, so keep the money. And if you die, tell your kids not to pay us back. Simple as that. That's the law.
It's tax law.
Basically,
It's about as simple as it gets, yeah.
Stimulate the economy so you can't get 75 grand.
Yeah.
Stimulate the economy.
That's a good way to put it.
Yes, ma'am.
What if you have title in a trust?
What about what?
Title in a trust.
Okay,
Yeah,
so
everything in
we're
your
gonna
trust.
talk about trusts, LLCs, all that kind of stuff. Okay. Let's go ahead and open our outline. First page says capital gain taxation. Here's how the tax is applied and who it applies to. Okay. So in 2012, capital gain tax was 15%. It's now 20. Okay. In 2012, you didn't have the 3.8% Medicare tax. You do now. Okay. So that's one of the reasons why and how the tax went up so significantly. Next page. The code. Okay. The code. This is a very confusing code because of what it says and what it means. Okay. So what it says is, no gain or loss shall be recognized on the exchange of real property, health and productive use in a trade or business, or for investment, if such property is exchanged solely for real property of like kind, which should be held either for productive use in a trade or business, or for investment. Okay. So one of the things this new tax law did is it eliminated personal property 1031 exchanges. So prior to the code of 17, or the new tax law of 17, you could exchange aircraft, collectible cars, art, all that kind of stuff you can do a 1031 exchange on. You can no longer do that. The only thing that this code works for now is real estate, okay? So if we say that Dawn's got to buy like-kind property, because that's what the code says, right? And so Dawn sells her property, and Lauren's now selling a commercial center, and that's what Dawn wants to buy. Is that like-kind? How many of you think yes? How many of you think no? I'm glad you raised your hand, because we'd have to stay till 3 if you didn't. So here's the thing. This is why it is so confusing, okay? Because we had one person get it right. Like kind is simply tantamount to real estate. Any kind of real estate qualifies for any other kind of real property from anywhere in the country to anywhere in the country. So Dawn can purchase whatever she wants from Lauren as long as it's real estate, including water rights, oil rights, mineral rights, easements. They're all considered real property, and they all qualify for a 1031 exchange. This is number 2 thing you got to know. First thing you got to know, get the exchange set up prior to closing. Second thing you got to know, the definition of like kind as it relates to real estate. Any kind of real estate for any other kind of real estate, as long as there's an investment intent. Okay? That's what the issue of like kind means. Okay? Real estate for real estate, any kind of real estate. And if anybody ever asks you, the answer used to be, well, real estate is in its own asset class, so as a result, any kind of real estate qualifies. We didn't have to mess with that anymore because the code was changed a little bit, because now it says real property for real property. It didn't used to say that. Okay? Real property for real property. Any kind of real property qualifies. Water rights, oil rights, mineral rights, easements. Has anybody ever heard of a DST? Okay? DST, Delaware Statutory Trust. Okay? Okay? A DST is a trust that's created in Delaware, and it qualifies. It's the only thing that's not actually real property that qualifies for this section of the tax code. Okay? So the question is, can I exchange into a REIT? The answer is no. It's not real estate. Then why can I exchange into a Delaware statutory trust? Because it's sold as a security and not as real estate. So here's what happens. I'll give you an example of a recent one. A company called Inland Securities went to the IRS, and they got a revenue procedure from the IRS that actually blesses this structure for 1031 exchangers. okay? So basically, here's kind of briefly how it works. Inland forms Delaware, they form a trust, right? And then they bought a $60 million Walgreens portfolio. They placed that portfolio in the trust, in the DST. And now individuals like Dawn can come in and buy a fractional interest of that particular DST, and it qualifies for her 1031 exchange. Okay, really, really powerful. They're pricey to get into, but man, it's most of them are really good, secure real estate. In fact, this portfolio itself kicks off about between 5 and 6%. But I mean, it's so powerful that if one of the stores in the portfolio go dark, you got a corporate guarantee from Walgreens that they'll that they'll cover the lease. So that's powerful, right? So, you know, you have to be a credit instructor or a credit investor to qualify for the DST and all that. And it is pricey to get into, but it can be invaluable if you need it, right? So the point though is understanding like kind. It's as simple as any kind of real estate, for any kind of real estate, from anywhere in the country to anywhere in the country. And knowing that as a real estate professional is really important, okay? It's really important because, you know, you're gonna run into situations like I ran into last week where somebody was selling, I forget what it was, they were selling some kind of real estate, and they wanted to buy improved property, and they wanted to buy land, and their CPA told them that it didn't qualify as like-kind property because it wasn't like property, because it wasn't similar property type. And you know, when I talk to a CPA or attorney, all I do is send them an email, cite case law, and send them the information. And then they're always pretty much, you know, appreciative of it because now they know, right? But if you read the code, the point is, if you read the code, it says property must be like for like. Natural assumption is what? It's got to be similar property type. Not true. Any kind of real estate or any other kind of real estate. Questions on the issue of like kind? Yes, sir.
You mentioned personal property. How do they address apartment buildings with furnishings? Or hotels with furnishings? What do you do with those furnishings? Are they incidental?
Technically-
We used to call them incidental.
Right? Technically, personal property doesn't qualify for the exchange. However, in most real estate contracts now, those things aren't broken out. And so as a result, you generally speaking, additionally, you know, you'd appreciate that property on a much faster level than you do the real property. So generally speaking, there's no gain associated with it. And that's how that works.
If you're gonna do an itemization
I
of.
beg your pardon?
An itemization, because they do a list of all the items, like in a hotel, you have bed taxes, you know, things like that come up. So the itemizations would probably be better left outside of escrow, right?
Absolutely.
Thank you. Okay.
Absolutely. Okay, next page.
Back just quickly to the
I'm sorry, again.
taxation. Oh, could we go back to this page for just a second?
Sure.
Thank you. So, if I'm understanding this right, it's a cumulative amount, so if it was number 2, then you're also adding 3 and you're also adding 4, so it's those 3 lines, that would be your total rate, is that right?
Right, so you have 4 different elements of the tax, right? You have depreciation recapture. That means you have to recapture the depreciation at 25% of what you've taken, okay?
And if you haven't taken any, then it's just the other 3.
Pardon me?
And if you've not taken any, it's just the other 3.
Yeah, if you've not taken any depreciation, there's no recapture, okay? Then you have the federal of 20 or 15, then you have the 3.8%, and then you have the state tax. One of the reasons why Dawn's tax is so high, tax due is so high, is because the tax in California is the highest in the country, 13.3%. In Arizona, it's about 6%. state tax.
And it was it not also deferred federal taxes in California? They were not, they were deferred as I understand it, and now they are not. So as I understand, California people are now starting to pay more of those taxes, and so when they're selling property there, they have a federal tax, and then of course, whatever state taxes they have there to deal with. So the 1031 exchanges are becoming more popular to buy like-kind properties in Arizona, Colorado, New Mexico, Arizona. where the
100%.
taxes are a lot-
California has the strictest laws in the country as it relates to this section of the tax code. They don't recognize certain things that most other states do. In addition, California has a clawback law now.
Right,
So-
that's what I was looking for, was a clawback law.
Yeah, the
Yeah.
clawback. So when you sell property in California, you have to file a tax return. And say you sell it in California, buy in Arizona. You still have to file a tax return on that asset every year with the California, I forget the name of the taxing board, until you either sell it, because what they want to do is try to track that tax so they get their portion of that state tax. So yeah, California is very, very strict. They don't recognize things like drops and swaps and things like that. And we'll talk about all that later. May I answer your question, ma'am?
Yes, thank you.
Okay, you're welcome. All right, so next page, page that says exceptions. So these are all things that do not qualify for a 1031 exchange, okay? First thing, stock and trade or other property held primarily for sale. So stock and trade refers to dealer inventory, right? So what's a dealer in our business? Like a home builder, right? So the homes that they build are considered inventory and they don't qualify for a 1031 exchange, all right? Property purchased primarily for sale, the other side of that sentence. What do you think that refers to?
Flipper?
Perfect. Flippers. If you're flipping property, it specifically does not qualify for this section of the tax code. And every flipper in the world will say, wait a sec, Joe, hold on. We just read the code. Code said there must be an investment intent. Why the heck do you think I'm going through all this crap if I don't have an investment intent, right? Very true. However, the first exception in the code is property purchased primarily for sale. If it's purchased primarily for sale, as far as the IRS is concerned, there's not an investment intent. You bought the property to sell it immediately, flip it.
Can't you live in it 2 years, right?
Pardon me?
You can live in it 2 years, right? A year, 2 years, what's the code on that before you flip it?
Okay, that's a great question. How long do you have to own property to have it qualify as investment property? Whoever gets this right, sleeve of golf balls.
A year.
A year is a good answer.
Approximately.
A year and a day is a
One
good,
tax year.
pardon me?
A
One
year and a
tax year,
day.
at least one tax year.
I thought it was
A year and a day is a good answer. 2 years is a better answer.
2 years.
The actual answer is, there's no minimum time, there's no maximum time. The IRS simply says there must be an investment intent. So a year and a day is a good guideline because a year and a day gets you beyond, gets you into, allows you to straddle 2 taxable years, right? 2 years is a better answer because there's a private letter ruling from the IRS that says 2 years sufficient time to hold property for investment, okay? The actual answer is there have been exchanges that have been owned for as little as 4 months that have held up in tax court. And there have been exchanges that have been owned for as long as 12 years that have been disallowed and did not hold up in tax court. It's all about intent and improving, being able to prove intent, okay? So how does a property qualify after being owned for only 4 months? Well, here's what happened. Couple buys, sells a property, does a 1031 exchange. Buys replacement property, right? Puts a tenant in the property immediately. Tenant signed a 1-year lease. After 2 months, tenant never made payments, they had to boot the tenant, okay? Now, they're looking for another tenant. They have a Realtor out there looking for a tenant. All done with the listing, blah, blah, blah. Their home burns down. Haven't found a tenant for the property yet. So they convert the use of the property by doing what? Moving into it, after only owning it for 4 months. Well, you know, that was documented, and the IRS said, wait a sec, you've only owned this property for 4 months. It doesn't qualify as investment property. So they go to tax court, and they were able to prove, one, initially, they had a 1-year executed lease. 2, they were looking for another tenant after they had to boost that tenant. 3, their house burned down. What the heck were they gonna do? So they moved into it, right? That held up in tax court.
How did they move into it?
That held up in tax court. I beg your pardon? So yeah, they converted the use. Now it's no longer an investment property, it's their primary because they're living in it, right? But you've got another deal where, a case law where person owned land for 12 years. But he was a civil engineer, and his initial intent, and he was just honest about it, was to develop the property and then flip it, right? But over 12 years, he just wasn't able to do that, but he never documented. So he said that my intent changed when I was unable to develop it to an investment intent, just holding it for investment, but he never documented the fact that it was, you know, he changed his intent. You can always change your intent with regard to real estate you own, but you want to document that, right? You want to document. He never documented it. As a result, after owning it for 12 years, the IRS disallowed it.
And how would you document that?
I was gonna say, how would you
Easy.
document it?
Send an email to your CPA or your attorney. Hey, listen, I initially purchased this property to develop and sell. However, I've owned it for this long a time, haven't been unable to do it. Now I just want to hold it for investment. Real simple, real straightforward, right?
So the thing you also need to be sure of is when you have a property, the affidavit of value, the assessor's office has it assessed correctly, because a lot of people do not want to report rentals because they don't wanna pay the higher taxes. So they.
Well, there's a lot of reasons why
I
people
change
do
it, so they
a lot
have
of
to be
different
careful.
things, you know, in terms of, you know, people buy investment properties all the time and use, you know, the loan is related to your primary, but it's an investment property, all that kind of stuff. What the IRS really cares about is documentation. And if the only documentation is the loan documentation, you might be in a little bit of trouble. But if you got the loan, and then you have documentation related to an investment intent, you're good. But you have to have that, okay? That's important. Stocks, bonds, or notes. You cannot exchange a stock, bond, or a note. Other securities evidences of indebtedness or interest. One of the things the big thing that refers to is seller carryback financing. So if you want to sell a property and you want to carry a loan and you want to do a 1031 exchange, the portion of the note you're carrying does not qualify for the exchange. Okay? The portion of the note you're carrying does not qualify for the exchange. Now, there are things you can do to abate that, okay? But, you know, they're pretty technical, and if you ever have questions about it, just give me a call. But there are things you can do to abate it. The big one is if you carry, you know, you buy out the loan while the note would go to the QI, and while you're looking for replacement property, you simply pay off the note to the QI. So you get your note back, and when you receive the payoff of the note, it's tax-free because you've abated it via the exchange. Okay, and like I said, it's pretty technical. If you ever have questions or issues, call me. Interest in a partnership. You cannot exchange into or out of a partnership interest, okay? You cannot exchange into or out of a partnership interest. So what does that mean? That means that, let's say Lauren, Dawn, and I own this building, right? And we own it in an LLC. And the LLC is a regarded LLC, so we all have a 1/3 interest in the LLC. We get an incredible offer for the building. We all agree we should sell, okay? We go into escrow. great partnership, but now we've all made a lot of money, we want to go our own ways. Can we exchange out of our interest in the partnership?
No. If you jump through a few hoops on the way, yes.
Pardon me?
If you jump through a few hoops on the way.
Technically, the way we own it right now, we cannot, right? But there are things we can do that would allow us to do it. And that would require the three of us to deed out of the LLC. Okay, it's not a taxable event. You deed out of the LLC. And then we acquire our interest in the property as tenants in common. Now when we're selling the property, okay, we're selling it as what? As real estate. Okay, we own it as tenants in common. We're selling 1/3 interest in the real property versus 1/3 interest in the partnership. Okay. Now there are a couple different issues with regard to partnerships. There's a regarded partnership and a disregarded partnership. That's the same with a trust. There's a regarded trust, disregarded trust. Any trust that is basically a living trust is disregarded for tax purposes. Any partnership, LLC, that is a single member LLC and doesn't file a separate tax return is, generally speaking, a disregarded entity. What that means for the IRS is that it's disregarded for tax purposes. In other words, the individual or the couple that owns either the trust or the LLC is the same as the trust or the LLC. In other words, the IRS considers it one entity because the taxes related to the income of either the trust or the LLC are filed from a personal return versus a separate return for the trust or the LLC. Yeah, any entity that owns real estate can do a 1031 exchange. If it's a regarded entity, it has to be the entity that sells has to be the same entity that buys. If it's disregarded, then that means you can sell in the LLC and buy in your personal name. And sometimes if you need financing, that can be advantageous. Okay. Questions on trusts? Yes, ma'am. Speak up, please.
Okay, so when you have a trust, it's a living trust. When you die, it becomes an irrevocable trust.
Right, and it becomes regarded.
Then it becomes irrevocable. So then, with the beneficiaries of that trust, can they deed out of the trust to their names individually and qualify for that step up?
No.
If it's, okay, because the irrevocable trust is inheritance.
Right.
Okay, so is there a way that you can work it? I guess you would
Well,
just have to.
when you inherit property in a trust, you get a step up.
Automatically.
You automatically get a step up.
Okay,
Okay. You don't have to deed out of it to get it.
good.
Okay. Any other questions? Partnerships. Okay, certificates of trust, beneficial interest, or chosen action, a right or judgment to property. So what really this is referring to is real estate. So if you own a lien on a property, right, you have a right or judgment. You have to own the real estate in order to do a 1031 exchange. You can't exchange a lien, you can't exchange a judgment. Okay. Next page. And by the way, this outlines for a 3-hour class, so there's a whole lot we're not going to really get into. Okay, we kind of covered this page on the first page. Talks about trust, regard, disregard, LLCs, that kind of thing. Next page should say like-kind property issues. So what doesn't qualify? A couple things don't qualify for a 1031 exchange, okay? Your primary residence does not qualify, generally speaking, for a 1031 exchange, right? Generally speaking. It can qualify, though, under certain conditions. So if you have a high-end property, and let's say you've lived in it for, I don't know, 10 years, and so you move out, and you rent it out for a year or two, right? Do you still qualify for both the 1031 exchange and the 121 exemption? So do we all know what that is, 121? So if you don't know it, it'll behoove you to really understand it. Because when you share it with clients, it's a big deal. And you can go to our website and literally print off a template that talks about section 121, put your name on it, hand it out during a listing procedure, okay? Because 121 is powerful. Who knows what it says? Here's what it says. Section 121, different section of the tax code, says that if you live in a property for 2 out of the last 5 years, you can sell it tax-free in gain up to $250 as a single individual, up to $500,000 as a married couple, right? Powerful, okay? So what does 2 out of 5 mean? You take the last 5 years, have you lived in it for 2 out of the last 5, okay? What it also means is that you can be out of it for up to 3 years after you've lived in it for 2 and get the 121 exemption, okay? Here's the deal. Married couple selling a high-end property that they lived in for 10 years. And they got it during the valley. They have very low basis in the property, okay? Let's say they bought it for $200,000, they're selling it for $1 million, okay? They moved out of it 2 years ago, okay? So they've got what, $800,000 in gain. They can take the $500,000 exemption, because they haven't been out of it for more than 3 years, right? They still qualify for 121. They can take the $500,000 exemption, and they've rented it out for 2 years. They can 1031 exchange the additional $300,000 and pay no capital gain tax. Again, very powerful stuff. Okay? So understanding 121 can be a big deal for you, and just talking about it in general, and just qualifying your client. Hey, how long have you lived here? Or a situation where you're talking to a client and they're selling a rental property. Did you ever live in it? Yeah, I lived in it for about 10 years. How long ago did you move out of it? 2 years ago. You've got liquid gold. Why? Because you're the only real estate professional that's going to tell them, hey, if we can get this thing sold in a year, you can take advantage of the 121 exemption and sell it tax-free. Are you not going to get that listing? So this just talks about, okay, your principal resident doesn't qualify, generally speaking, and property held, unless, again, you convert the use of it and make it an investment property, and property held for sale and dealer inventory. Those are the 3 things that really don't qualify.
Joe?
Yeah.
I have a question. So if you have so say you've got a client that's got over $500,000 and it's currently their primary residence.
Uh-huh.
But they bought it, top of the market, 2005. They've had it for 14 years.
Mm-hmm.
They leased it out for 8 of those 14 years.
Mm-hmm.
But then now they've moved back into it.
Okay.
And they're trying to sell it.
Okay.
So would they qualify for that?
No, because they live in it now. If you're living in it when you sell it, it's a primary. You got to be out of it. It has to be rented out. Okay. So let's turn to the page that says vacation homes.
Sorry, back to that. So, if we are in a listing presentation, they're currently.
I'm sorry, John. Like I said,
I'm sick right now, sorry. If they are living in it, we're in a listing presentation, and can we coach them to move out of it and sell it in 2 years? And that would, they'd be in a better position? Or?
Well, now we're talking about coaching. So,
We just give them your number.
yeah, there you go. Hey, you can say, there may be some really creative things you can do.
Yeah.
Call Joe.
Okay.
I'm happy to do that.
What's your phone number?
I'll have a cards brochures.
Okay.
So, in terms of coaching, one of the things I would do, and one of the liabilities associated with being a real estate professional and talking to folks, is that there is inherent liability in just about everything we do. Why do we get sued all the time? Because 90% of the time, we go to court, we lose. Most of the time, E&O settles, right? So, what can you do to eliminate or abate your liability related to a 1031 exchange. Because of the 5 calls I get a week regarding doing an exchange and they've already closed, a lot of the time the realtor has told them to call me after they've closed, right? So, is there liability? Yeah, there's liability. Person sells a property in Maryland. This is just a live example, a real example. Person sells a property in Maryland and sells a property in Maryland. After he closes, he goes to CPA, owes $450,000 in tax due. Okay. Commercial real estate, obviously. And so the CPA says, why didn't you do a 1031 exchange? Because he was buying other property anyway, right? And investor says, well, what's that? And CPA says, well, why didn't your realtor tell you to do a 1031 exchange? Investor says, I don't know, picks up the phone, calls the realtor. Why didn't you tell me to do a 1031 exchange? Realtor's response, what's a 1031 exchange? Realtor and broker are sued. They settled for the whole $450. Okay. How do we eliminate that liability? It's really simple. You qualify your client. What are they selling? Does it qualify as for 121? Is it an investment property? How have you owned it? Those kinds of things. Qualify your client so you know whether it's an investment property and or it qualifies as your primary and or both, right? So if it's an investment property, I would approach it this way. I would say, look, there may be some really creative things you can do to abate or avoid paying capital gain tax. As a real estate professional, I cannot give you tax or legal advice. Call Joe. Here's my card. Call Joe and talk to him about it. And then after you do that, you simply send a single email. Hey, did you talk to Joe at Asset? And you're covered. Okay, you're covered. In fact, I had a big deal here in Tucson where I was doing a class for Stewart Title, and the president at the time asked me to stay after and talk with an agent and her client who was a rancher, okay? Inherited a big family ranch, selling it for millions, right? I forget what the number was. It was 5 or 6 or 7 million, something like that. It was a complicated deal, BLM land, all that stuff, right? So I sat down with the seller and his agent for almost an hour. I said, so you're under contract now? Yeah, when are you closing? About 30 days. You haven't found replacement property and we're looking for $5 million worth of property and we got to get it done in 45 days? I said, delay the close. Whatever you do, delay the close. Did the rancher delay the close?
No.
He did not delay the close, right?
Right.
We do the exchange for him. About a year later, I get a notice from a law firm to fill out related to the transaction, so we fill it out. We send it back, and I'm doing an 8-hour class. I was a lot younger back in those days. I couldn't do an 8-hour class anymore. I was doing an 8-hour class for attorneys and CPAs, right? And there was a rather dapper gentleman sitting up front, and he's asking all these questions about liability. And I said, what? Give me an example of what you're doing so I know what we're talking about here. Well, it turns out he was an attorney for that rancher who was suing the real estate professional. We went to lunch at a lunch break, and he told me who he was and what he was doing. And I said, is it the blah, blah, blah file? He said, yeah, we did that exchange. He goes, I know, that's why I'm here. So I talked about what that realtor did, and I talked about how she documented what she documented, and I said, you don't have a case. And E&O won't settle on this deal because in writing, she advised her client not to close. So they were suing because they couldn't find replacement property in time, and he had to pay capital gain tax, right? So they're going to sue the agent. This agent wasn't even the agent who sold the dang property. He was just helping her look for replacement property. And ultimately, they dropped the case. And he said, well, we're using the poor old dumb farmer sort of action versus a sophisticated real estate professional, who, by the way, took this rancher from the office there to an attorney. Attorney advised him, do not close. Delay the close till you at least have an idea of something you can buy. Of course he closed, okay? But eventually that was dropped. But document stuff. Qualify your client and document stuff. Okay, vacation homes. We all on that page?
Joe, can I just go back? Just to clarify the 121, I mean, I know this is really about the 1031, but just to qualify, so you live in the house 2 out of 5 years, and
Let me see if I have it.
what was the other qualification?
Okay, if you flip up, and we'll cover it briefly, but it's in writing in here,
Oh, okay.
and we'll cover it here in a bit.
Okay, great. No
Okay.
worries.
So vacation homes, can you exchange into a property that you use for personal enjoyment and or a second home? The answer is no, unless you qualify by doing what this page says. What this page says is that if you own a property and you want to use it for personal enjoyment, you can, and do a 1031 exchange if you do these things, okay? 2 years prior to disposition, you have to rent it out for at least 14 days a year at fair market, and you can't stay in it for more than 14 days a year at fair market, okay? Or at period, for 2 years prior to disposition, and you have to take depreciation on it for 2 years prior to disposition. If you want to acquire a property and use it for personal enjoyment in a 1031 exchange, you can, as long as you do exactly the same thing. In other words, 2 years after acquisition, you rent it out for at least 14 days a year at fair market. You can't stay in it for more than 14 days a year for 2 years, and you have to take depreciation on it for at least 2 years. If you do those things, then property used for personal enjoyment can qualify for a 1031 exchange. Might be easier just to run it out for a year. I'd get it done faster. Okay. Questions? Clear as mud, huh? Okay, so there's about 4 things you need to know to be very, very effective with this section of the tax code, okay? And let's talk about those things. What are they? 1, first and most important is what? First and most important, again, interactive, folks, come on. First and most important is what?
Don't close.
Get the exchange set up prior to closing.
That's right, don't take.
Okay? Second thing, definition of like kind. Why is it important for you to know? Because if somebody just reads it, it's very confusing. Well, wait a minute, it says like for like. That's true, it does say like for like. It's just that any kind of real estate is like kind to any other kind of real estate as long as there's an investment intent, right? So that's number 2. Number 3, all right, is the exchange equation. And I some of the smartest people I've ever met in my life, it's a really straightforward requirement, but what a lot of people do is they get this requirement tangled up with a lot of other things in the code. It's a standalone requirement, it has nothing to do with anything else, okay? And here's what it says. It says you have to reinvest your net equity, but you also have to acquire or reestablish the same or greater amount of debt that existed on what's called the relinquished property, or the property you sold when you sold it. So Dawn's selling her property, $275, got a $25,000 cost of sale, okay? $25,000 cost of sale, and our net is $250. Closes the property, the $125 net equity comes to us, right? What happens to the $125,000 debt or mortgage that she has on the property? What happens in every real estate transaction when you sell a property? It gets paid off, right? It gets paid off. one of the things I hope to convey to you as well today is that just because somebody's doing a 1031 exchange doesn't mean anything in the real estate negotiation, transaction, financing changes. Nothing changes. It's just that an individual taxpayer is doing a 1031 exchange. And there's some, you know, it can be very, very technical, but if you look at the transaction at its basis, Dawn's gonna sell a property, she's gotta get the exchange set up first. We've got a timing issue, right? So she's looking for that replacement property before she closes. She finds Lauren's property, right? And she's gonna buy Lauren's property. So the equity comes to us, debt's paid off, right? If Dawn is going to reinvest her net equity, 125, reestablish the same or greater amount of debt, 125, at a minimum, what does she have to buy for? 250, right. Okay, so she buys Lauren's property and she only pays 225. What do we know? We got boot, right?
It's gonna get cash boot.
You pay tax on the boot. There's two forms of boot, generally speaking. Okay? There's mortgage boot and there's cash boot. When Dawn sells the property, she pockets $25,000 cash. Obviously, that's cash boot. She's got to pay tax on it, right?
Right.
However, this time, different situation. Dawn reinvests the entire 125, but she only establishes $100,000 in debt. Now we have a thing called mortgage boot, and you'd pay tax on that boot as though you took it in the form of cash because the IRS considers it debt relief, and as a result, you pay capital gain tax on it. Okay. Questions about the requirement? It's real simple. You take your sales price, you deduct your cost of sale, and that's what you got to buy for. Yes, ma'am.
Is there a limit on the cash boot that you can take out?
No.
Okay, so you can take out as much as you want.
Yeah.
Just be prepared.
You just pay tax on it, is all. Questions on the requirement. This is the third thing you have to know, okay? So you got get it set up, like kind, the requirement. And if you know those things and you qualify your clients, you can be very effective with this section of the tax code, okay? There's a lot of, you know, I mean, there's 159 pages of just this one section of the tax code. So it can be very involved and complicated, but if you look at it, generally speaking, at its basis, you're going to sell something, followed by the purchase of something. It has to be equal to or greater than what you sold it for, and there's timing. And if you know those things, again, you can be very, very effective with section tax code. Next page. Speaking of timing, if anybody gets this correct, sleep with golf balls. Okay, so we have an example of how the exchange works, right? Our taxpayers, Dawn, our buyers, me, we're the qualified intermediary, and the seller is Lauren, okay? So a taxpayer does an exchange, we get the exchange set up. I'm the buyer, so I buy Dawn's property. No, I'm not, so when I say me, I mean me as an individual, not me as a qualified intermediary. So Dawn sells the property, money comes to the qualified intermediary, we hold it until Dawn's ready to buy the property from the seller, Lauren, okay? We then transfer money to title, Dawn buys the property from the seller, end of transaction, okay? There's timing involved, you can see that timing below. True or false question. From close of escrow, which triggers a taxable event, right? You have 45 days to identify and a maximum of 180 to acquire. True or false? How many do you think true?
I think true.
Anybody false? Why, Mike?
Devil's advocate.
Pardon me?
For no reason other than being devil's advocate.
No golf balls, my friend. You know?
You can extend it, but as I recall, you can extend it, but there's a penalty on the tax if you do it. I might be wrong.
You can
On the
extend
tax.
what?
Well, I mean, like if you're over the 180 days,
Uh-huh.
then there's a penalty. I mean.
Yeah, all of your taxes do.
Oh, okay. Well, then I guess I'm.
No, I think I know what you're thinking of, though. Okay, because it's false. The answer is false. It's 180 days, or when your tax return is due.
That's what it.
Yeah. So 180 days, or when your tax return is due. So if you're selling property at the end of the year, right, And I think the date for 2018 was October 15th or 18th or something like that. If you sell between October 18th, 18 and December 31st, 18, you don't get your full 180 days because there are only 179 days from that October 18th to April 15th, 2019. So you shorten it
Wow.
within that 180 days. Now you can file a tax extension.
On the end,
Right.
yeah, that's
You
what
can
I
file
was
a tax extension to get your full 180. Okay? But guys, understand, these are safe harbors. Adhere to the safe harbors, you won't have any issue. Get outside the safe harbors, you got issues. Next page. Okay, so identification. There are 3 rules. Most often, the first 2 rules are what's used. So the 3 property rule says that, first rule is the 3 property rule, and that says that you can identify up to 3 and buy 1, 2, or all 3 of them with no limit in value, okay? If you want to buy more than 3 properties, you can. You roll the 200% rule, and that says you can identify any number of properties, so more than 3. However, the total fair market value of all properties identified cannot exceed 200% of the value of property sold. So that means Dawn can identify 5 properties in the 200% rule, but they can't exceed $500,000 in value. So most of the time, in terms of residential real estate, you're using the 3 property rule, okay? And identification is just a process of the exchange. You get a list from us, has to be signed, dated, and received by midnight of the 45th day, and you can buy whatever's on that list. Okay, it's pretty straightforward. You can identify anything. You can drive by this building, identify it, write down the address.
What if they sell and you identified them, but you didn't get them under contract yet?
Dawn, that is the reason why. I beg, I implore my clients to get the real estate professional looking for the replacement property prior to closing. Because now, if you have property under contract, you have that 45 days to get your due diligence done. Let's say you identify 3 and you're really focused on 1, okay? And you have it under contract, but you don't get your due diligence done until 47th day. Thing comes back and it's got a bad roof, you can't buy it, right? So you go to the other 2 that you've identified, well-priced properties in this market, are they there?
No.
They're gone. So that's why I really encourage folks to be looking for replacement property as early in the process as is possible, okay? Most of the time, people get it done, most of the time. But when they don't, there's a new thing out there called an opportunity zone, and that was created with the new tax law. And if you get past your 45 days, you can't do a 1031 exchange, but you still could go into an opportunity zone and abate the tax, okay? So that's not part of this class. If anybody wants to learn about an opportunity zone, you can go to our website, and we have a webinar on our website related to all things OZ, opportunity zone, okay? Okay, so the list must be signed, dated, and received by midnight of the 45th day. Okay, midnight of the 45th day. Questions about identification? All right. What not to do in exchange? The big one here to me is Dobrik. So what did Dobrik do? They did a thing called backdating, okay? And they also screwed a real estate professional out of a fee, and that's why they got caught. So this was back in the days. This is back in the early 90s when the safe harbor for this code just came out. And so the Dobricks did a 1031 exchange, but they had a $2.2 million tax liability. In other words, they owed 2.2 in tax. Big deal, right? So they couldn't find replacement property till like the 65th day, 20 days past the 45 days. So they were able to get a hold of their identification list and they backdated. In other words, they identified and they said it was date 43 in the transaction as opposed to date 65 in the transaction, right? So then they didn't pay a real estate professional who was involved in the deal, and then the real estate professional knew that they backdated. So then the real estate professional picked up the phone, and what did he do? He called the IRS. So the IRS is looking at the deal, and now it's a he said, she said, right? Because they have the document that says they identified on this date, but the Realtor says they backdated the document. How does the IRS figure it out? Well, the IRS finally realized that the property the Dobrik's identified wasn't even on the market until day 65 of the transaction.
Oh gosh.
Did the Dobrik's have to pay the $2.2 million in tax? There's a million things you can do. There's a million aggressive things you can do in real estate, right? Like if you're a flipper and you're flipping a property and you want to do a 1031 exchange, you can. Is that fraud? No. In the flipper's opinion, it's an investment property. Hey, I didn't know any better, whatever, right? IRS disallows it. Are they going to charge you a fraud penalty? No. They may charge time penalties, in terms of timing, but it's not fraud. Fraud is this, right? So the Dobrik's only had to pay the $2.2 million. Anybody know what the fraud penalty is? 75%. $1.6 million penalty and jail time because they initially lied about it. So those are some things you may or may not want to do. Okay, next page.
Did the real estate agent get paid?
My understanding is that
Right there.
my understanding is that the IRS really appreciates whistleblowers
Thanks for the tip.
in most cases.
Good question.
Okay, we already talked about this, but let's look at the bottom of the page. It says IRC section 1031. So this is kind of how it's outlined. Simply own a property for 2 out of 5 years. You can sell it tax-free and gain up to $250 as a single individual, $500 as a married couple. Are we all on the same page?
No.
Says IRC section 1031 and section 121. The next page after Dobrik.
Sorry.
Got it? So on the bottom, we have a whole template that talks about section 121, right? And you can go to our website, click on the template. You can actually customize it, put your name, firm name, number, email address in it, click outside the box, print it with your name on it, and use it in your daily business. It's powerful. And just as an example, you guys are all inquisitive real estate professionals, but a lot of you didn't know about 121, right? Just knowing about it and applying it in your daily business can be very, very effective. Okay, so this talks about, this next page, convert rental into residence. This talks about how to do that, okay? And next page.
We're skipping past into the.
We're now on the page. Keep flipping until you see the page FERPTA.
Can we briefly talk I have a quick question about the rental into residence.
Yeah.
So hypothetically,
Yeah.
and it's been a long time, so I might be, but if, let's say, I bought an investment property 10 years, 15, 20 years ago, whatever it was, and over time kept doing 1031 exchanges and kept moving up in properties, and I've moved it up to say, I don't know, a 4-plex or a 6-plex or apartment complex or whatever, and now I'm getting older and I want to downsize. So I've done what you said. Now I've taken these and I've sold them and I've created maybe something a little bit smaller, and now I got one of them over time that I'm going to eventually convert into a residence. Suppose I'm 75 whatever years old and I've deferred all this tax for 50 something years. And I've got all these properties and whatnot, and I'm going to take one of them, I'm going to convert it into a residence. I convert it into the residence, I live as the tax in the 121 says, I pass on, my wife passes on. My children now can inherit all of the all of the properties tax-free, including the one I lived in, provided that it's not in the estate tax provision over $1 million. Is that correct? Or I know you're not a tax
I think
professional,
that taxes right now are about 5.6 million.
Yeah. Okay. So as long as I stayed under that, then that plan works.
All day long.
That's
It's the
what I
most
thought.
powerful tool left
Yeah,
to us to
'cause I mean,
invest in real estate.
that's the way I initially learned 1031 exchanges, 15 years ago.
Right.
Yeah.
That's the plan. There's a term called swap till you drop.
Right.
Very, very powerful.
That's how I heard
Your
it.
heirs inherit.
That's
They'll
what
love
it
you
is.
even more.
Okay.
Okay, the page that says FERPTA at the top of it. So the FERPTA withholding is for foreign investors, right? It's a federal reporting act. And if a foreign investor sells real estate, they have to adhere to FERPTA. In other words, 15% of the sale proceeds goes directly to the federal government, okay? They can, if a foreign investor wants to do a 1031 exchange, they can avoid the FERPTA two ways. They can get a waiver from the IRS. Takes about 90 days to get it. And then they can do a delayed exchange, right? Or they can do a simultaneous exchange, okay? And that is, Dawn sells today and she buys today. You buy and sell in the same day, okay? Under those two circumstances, a foreign investor can avoid the FERPTA.
Oh, wait a minute.
Wow.
No, wait, no, okay. So I have a question.
Sure.
So do you have to have a social security number?
That was what I was gonna ask.
Oh,
because-
What was the question?
Well, my question, okay, so the question was, she said, do you have to have a social security number? But the question is, because of their FERPTA, you're saying that they're able to avoid the tax.
They have to have a tax ID number.
Okay, so the EIN would work,
Right, so
or?
they have to apply for one no matter what.
Yeah,
So,
Okay, and that's why it's 90 days? Something like that, to kind of,
that's just what the IRS.
Okay.
That's just what the.
It's an IRS thing.
Okay.
You know, so let's say you've got a foreign investor who's selling something and they can't delay the close. They're not going to get 90 days. What can we do? Well, what we can do is do the exchange, okay? And we just simply set up a separate escrow for the 15%.
Right.
Okay? When they get their furlough from the IRS, that 15% goes into the exchange. Okay? If they don't get it,
goes to the IRS.
goes to the IRS.
Right.
Goes to the, yeah.
Okay.
Okay.
What about vacant land?
Pardon me?
Vacant land,
What about it?
do you still hold 15% or do you go to?
Any real estate.
Any real estate?
Mhm.
Okay.
Due diligence. Why is it so important to know who you're working with? Who can tell us what sleeve of golf balls? Somebody gets this right. By the way, I rarely give away golf balls, as you can tell.
Are you related to like the Calloway family?
I am.
Are you really?
I am.
Oh my.
I'm a cousin about 250,000 times removed.
So no free golf balls for us.
So anyway, yeah, going back 2 generations, all Callaways claim the same heritage. So why is due diligence so important related to a qualified intermediary? Who can tell us what governmental regulatory body oversees what we do with your money? And by the way, large QI set on a lot of money. We just did the largest exchange ever done with a REIT, 1.5 billion. Set on a lot of money. What governmental regulatory agency oversees what we do with your money?
FDIC?
FDIC, nope.
Okay. That was my guess.
The IRS.
No golf balls, okay. There isn't one. So the IRS says, look, if you want to do a 1031 exchange, you must use a qualified intermediary. And by the way, we're unregulated.
So
Okay?
anybody could be a qualified.
Unregulated. One of the largest QIs in the country in 2008 went down. Why? Because they took what we call the float. And what's the float? It's the money we hold. Dawn sells her property, $125,000 comes to us. We do that a whole lot, right? The largest deal I've ever personally done is $105 million, and I wrote up a lot for $50,000 the other day. So we run the gambit, right? But there is no government. So let's talk about Land America. What happened? So they were a big qualified intermediary, but that qualified intermediary was investing in short-term treasuries.
With the float,
The float, yeah.
or the floats?
The float in, that's what they were investing the float in, right? And in 2008, you know, that was a very secure investment, been around for 100 years. And the big banks of the world took turns buying up excess inventory that wasn't sold, right? So in 2008, guess what happened? The big banks said, we ain't touching it, right? It was frozen. So all that money that was sitting in that investment was frozen. And so what happened was, you know, a couple of big exchanges were called, $30 million exchanges, what have you. The QI didn't have access to the cash, they went out of business. Did the individuals that couldn't complete the exchange still have to pay capital gain tax? Absolutely, they didn't complete their exchange.
Oh, wow.
So understanding, and then there were a lot of little ones that went, you know, belly up. This is our 30th year in business, okay? One of the reasons why we're the largest, or certainly one of the largest QIs in the country, is because we have the best security and service in the industry. So security is paramount. So what do we do? What are the questions you ask? Well,
How do you invest your float?
we don't invest it. We have it in the, we open a segregated account for each taxpayer, whether it be $1 billion or 125,000. Okay, segregated account in the largest banks in the country. Okay, of course we're bonded and insured, all that. But I can tell you that hundreds of thousands of exchanges over our years, and we've never been, well, we've been sued twice. Both those suits were kicked as frivolous. We also have the best guarantee in the country, and that guarantee comes from our parent, okay? Parent steward title. Steward title guarantees your money and our work, okay? It's the best guarantee in the business, and that's why everybody from Disney to Exxon works with us, okay? Cards and brochures back there, folks. Next page is just my number and contact information. I'll be around for as long as anybody wants for questions. Appreciate your time again. Thank our sponsors.